Okay, welcome back. Can you hear me at the back? Oh, well done for the assignment is due this week, which presumably, hopefully won't be a surprise to anyone. Although someone told me about confessions at UWA where they said, is it too late to start? And the response I liked was, due today, do today. So it was good. Today I'm going to look at macro analysis. So from this week and next week, we're looking at how you analyze a company. Some of this will be covered in this general subject matter, will have been covered in some other subjects, but I'll be hopefully bringing some new perspectives here that you haven't covered in other lectures. So the thing with fundamental analysis is at different levels. You have three things that affect the company: the global, the economy, the industry, and then the company-specific factors themselves. So what we're looking at today is the domestic and global economic analysis. The assumption is that the state of a company's industry, local economy, and the global economy affects equity returns. Now that is true, but it affects it in ways that are not quite as straightforward as one might think, and that's what I'm going to go through. So essentially, the task that we have is, if it's an efficient market, then you don't have to worry about this, if markets were indeed efficient. But the thing is, a lot of markets, you don't have publicly available information, so they're often private markets, so you have to undertake some fundamental analysis. But even in a public market, you can believe that the market is inefficient, so you might want to do your independent analysis rather than taking the market price. And the basic task that you have is to look at the intrinsic value calculated in some way. So the intrinsic value could be a function of several things. It could be your own private valuation. So if you have a painting, you could think about what's the painting worth to you, the emotional value, etc. From a finance perspective, we generally look at it in terms of the cash flows, the discounted cash flows. And then having worked out the discounted cash flows, you then compare that to the market price and you see if it's higher or lower. Obviously, if it's high, you don't buy it. If it's lower, you buy it. If it's equal, it offers you fair value. So the question, as I said, what determines intrinsic value? This could be a private valuation. So if you have your own things for a painting, or it could be something. But in finance, we work out cash flows is what matters. And the relationship between intrinsic value and market price depends, again, on how competitive the market is and the market efficiency. So what we're doing here is you can't tell for sure, predict, but you can have an estimate of the probability of distribution. So this is the expected returns increasing, and here's the probability. So a lot of the times it'll be normally distributed. That's the assumption we make. And in an efficient market, the estimated distribution of returns will equal the true distribution. But if there's an inefficient market, there'll be something different. So I'd like you to think over here, we have the estimated distribution of returns, and here's the true distribution of returns. So what do you think's happening over here? The market will, if the estimated distribution is this much and the true distribution is to the left, then the company will be undervalued, overvalued, or just the company will be overvalued, right? Because people are estimating it's this much, and when actually the true distribution of returns is less. So have a look. The kind of thing that we're looking for are measures of growth. Now, you're looking at performance metrics, and let me take you back to about 70 years, in 1950, where you're comparing IBM. IBM was then the tech stock of its time. Think of Tesla or Uber. And you have Standard Oil of New Jersey, which is the old technology stock or the old industrial stock. And we see that between them, people were predicting IBM would be, the revenue per share was 11.9%, the growth. Standard Oil of New Jersey, the growth per share, the growth in revenue was 8.93%. Dividends per share, again, higher growth for IBM than Standard Oil of New Jersey. Earnings per share. And the sector growth, importantly, in IBM, the computing sector, that was expected to grow, whereas the oil industry was expected to shrink. So given those figures, which one would you have bought? Every instinct is probably saying, well, Standard Oil, of course, or IBM, because it's outperformed on every measure. But then you're thinking, why would he put this up if there wasn't some trick question to this? Actually, you'd have been better off if you had bought Standard Oil. And the answer goes back to this slide, which I said, and you nodded your head and said, yeah, okay. Why? Because what you are comparing is the market price to the intrinsic value. That's an important lesson. This is the true things that you're comparing, the intrinsic value and the market price. You can have a very attractive investment, good in all respects, but it's not a good investment if the market price is greater than the intrinsic value. So IBM was a very good company in 1950 and continued to be a good company. It fulfilled all its predictions. But Standard Oil was a better bet because while Standard Oil's intrinsic value was lower, its market price was also lower than its intrinsic value. So people undervalued Standard Oil and overvalued IBM. So a good company doesn't make a good investment. It really depends on the intrinsic value and the market value. So we can say that Apple might be a good company, a great company, but you wouldn't necessarily invest in it, which is relevant, of course, to your assignment. Have a look at the valuation of the company. All of these things could be true about lithium, but is it overvalued relative to the benefits there? So this tells you, Jeremy Siegel puts this up in his book and says that he simply makes the point, if you did invest in Standard Oil, you would have done better over the years. The difference would be worth 1.8 million, whereas 1,000 invested in IBM would be worth 867, less than 1,000, because you've overvalued it. So the framework for analysis of company value, there are two components. We have the cash flows and the discounted cash flows. And then you have, so that's this part, and plus the growth options. And so you're looking at a company, you're looking at two things. What will be its cash flows into the future, and what are its growth options? So we find that a lot of companies fall out of favor, even though they're doing particularly well. So General Motors, for instance, has much greater cash flows, positive cash flows than Tesla, but Tesla is valued higher simply because while General Motors' component discounted cash flows are worth more, Tesla's growth options, the value of Tesla's growth options are far greater than General Motors there. Sticking for the moment with the discounted cash flow analysis, there are two components. This is you estimating the cash flows, and this is depending largely on company and industry-specific factors. Now, if you're a value investor is someone like Warren Buffett. They'll look at an individual company, and they'll see how likely are its stream of incomes likely to grow in the future, its stream of cash flows, and how protected are they from competition. When he finds that kind of a company, he invests in it. He doesn't spend a lot of time on the working out the discount rates. The discount rates are largely economy-wide factors, so they're out of control of a company. So it's mainly when you're looking at a particular company and a particular sector, you're looking at how strongly the cash flows are. Now, one of the reasons why a lot of fund managers haven't outperformed the market is because the large part of the prices of the indices have been driven by decreases in interest rates over a long period of time. And so the decreases in interest rates have outweighed any value you might have added from looking at the cash flows of particular companies. So that's why fund analysts have really underperformed the market for a period of time, for a considerable period of time. And So estimating the discount rates, which is important to valuing all companies, but this is the common factor across all companies, depends largely on cost of money, which is a function of the economy-wide factors. So I want to relate some of this to, now what I want to do today is really explain this a bit more. So what's different about this lecture from others you might have come across is that typically you'll talk about discounted cash flows in a finance class and you won't do any competitive analysis. So I want you to answer this question, to be able to know how to approach this question. If you're asked, here's a company, go and do a valuation. And I'll think, oh, okay, I'll go and look at the cash flows, the discounted cash flows. Then you think, oh, where do I get the discounted cash flows? How do I go about estimating them? How do I go about working out the discount rate? So I'm going to give you a framework in this class to look at that. So before we get that, I want to also relate this to the kind of the wit and the wisdom of Charlie Munger. So Charlie Munger is 95 years old. Warren Buffett is 89 years old. And they're the most successful investors by some standards by all time. And there's recently he gave 6 hours an interview to Jason Zweig and Nicole Friedman of the Wall Street Journal. And there's this kind of thing where they've been quite successful, so they've attracted quite a following around the world. This is the kind of thing, if you're successful in business. There's another study today that said rich people don't know what they're talking about, but people like to listen to them anyway. That was in today's Financial Review. So rich men, actually. Sorry, being a bit more specific about this. But mind you, I think he's got quite a... But there's this interesting thing about people wanting to follow people who have made a lot of money, and he says, what do you make of the worldwide fan club that you and Warren Buffett have attracted? And he said, well, the world is very peculiar. These people that like me are mostly nerds in China and India. It's a very deep attachment. They're so passionately interested in improving themselves. Some of them just want to get rich in some easy way, but mostly they're trying to improve themselves. But actually, it's not just people in China and India. It's actually quite a worldwide phenomenon. So the attraction of a successful businessman. Jack Dorsey, he's attracted I don't know that Gwyneth Paltrow was some kind of influencer, but she is. But he is the tech's foremost manfluencer, guiding his followers to optimum cognitive performance. So they say, young men seeking to emulate him are staggering, hungry for days because he's got this keto diet. So he's very thin, so he tries to maintain thin for optimum performance. They're throwing themselves into ice bath, cryotherapy pods. They're not offering up beds into silent vegans meditation centers to accommodate them. So these are the followers of Jack Dorsey. The other person is, of course, if you don't like his style, you've got who behaves more the typical way of a billionaire, Elon Musk. So he's so drawn to his brash hypermasculinity, angry tweets. Anyway, back to Charlie Munger. So he's making the point, if you're just starting out as an investor, what approach would you take? And he says, well, the fundamental thing is that make sure you're getting more than you're paying for is correct. So that's the basic first slide that I had. The intrinsic value must be more than the price that you're paying for it. But the other point that he makes is there are different prices. You have to look for it in different places, and you're always looking for more value. And this is the point I want to make. You look at it in different. Sometimes people look at it in stocks where the earnings are going up. Some people look at consumer goods. Some look at bankruptcies. Some look at distressed debt. There are different ways to make money, and I'll show you some of these ways when I set out my particular framework over here. He makes a point about Li Lu of Himalaya Capital Management. He's looking as an investor training to look for deeper values, and he's had a good track record in Korea, but he wouldn't have found that elsewhere because the techniques that he's used in Korea have been used elsewhere. The other point he made in that same interview, this is in a different article, but the same interview, he said he'd read The Rebel Allocator, and he liked it because it ridicules some of Mr. Munger's favorite targets, including the quantitative claptrap taught in finance classes. And I think it's an important point. So there's a lot of quantitative analysis that you have to bring, but so there's a lot of qualitative analysis that you have to bring to make a good investment, as you're finding out in lithium. It's not all about just discounting the cash flows. You have to make particular judgment calls. And that's the nature of the kind of qualitative analysis you have to do that I'll be showing you in a minute. Okay, so going back to this framework, you have this is the fundamental, this is what it's reduced to, a summary of what you're trying to do. But if you're given this task of working out the value of a company, so you want to work out the cash flow, the first thing you do is you break it down a bit more. You start off with the sales volume and then the profit per sales. It's pretty simple. And you work that out from the balance sheet. You next want to know whether the sales volume and the profit per sales will continue into the future. Now, typically, what you'd really like is to have a high sales volume and obviously a high profit per sales. But generally, there's a trade-off between the two. You can't have high profit margins and high volume of sales. That generates an enormous amount of profit, but that profit will in turn attract a lot of competition, unless there are barriers to entry. So you need to then break that down even further. So that's your first step. You've worked out your sales volume, your profit analysis. Now you need to think, okay, how can I further analyze this? And then you look at you break it down further into things like the firm competitiveness, the cost of production, the product differentiation. So how difficult, generally, if you can have a product different from other in a valuable way, then it's easier to sustain the profitability over a long period of time. The quality of the management, the technology, and the politics. Now, one of this was the speakers who came on last Tuesday, so if you came to last Tuesday evening's talk, you'd have seen the speakers. And they spoke about, they didn't mention this explicitly, but in their conversation about the lithium industry, they said people had to focus on three things, essentially. The economics of it, the technology, and the politics. One of the points that James McClemens made said there's no shortage of lithium in the world. In fact, lithium is super abundant. So if it's super abundant, how come there is a boom in lithium? It partly depends on how do you extract the lithium and the technologies that come from extracting. There are different technologies and a limited number of companies who can extract it at an economical basis. So you need to look at the technology. He also made the point that and I won't give this where the thing is from because just to avoid handicapping those people who've done their work beforehand, but he said there's also a political element to the lithium boom. It's driven by a strong political element. So you had to analyze that and work out whether that will continue into the future. And then there's, of course, the economics of it. But to give you an instance of how the politics is important, we have Wesfarmers. So Wesfarmers, a couple of months back, made a takeover bid for a company called Lynas, which has an operation in Malaysia. It has a processing plant in Malaysia, exporting the raw material from Australia to Malaysia, and then processing that. And that material then, the byproduct of it is slightly radioactive. So managing that has proved a bit of a problem for the company. The Malaysian government has decided that, no, it's not good enough for them to have the mildly radioactive waste in Malaysia. So this company has run into this political problem. Wesfarmers has then come in, made a bid for this, and the basis of its value adding is that it's a large company which will be able to better solve this political issue better than the company itself, than Lynas, which the company is, of course, resisting. But my point is, it's an example of the political element affecting the value of this particular company. Otherwise, the company is very well run. You're also looking at things like barriers to entry, the leverage capacity, and the competition, and one of the points I'll make is that sometimes the companies with the highest barriers to entry are not that obvious. So oftentimes there's intense competition in the tech industry, whereas in other more traditional industries, there's more opportunity to maintain profit for a longer period of time. But these are the kind of things that you need to consider. The other point that was made is that by James, and again, I don't think I'm giving too much away, is that he says his company, which is not invested in lithium. So although he brought all these people together, so Gigi works in Hong Kong, she's a director of mineral resources. Peter McSweeney is the CEO of MSB, a company that's building $1 billion lithium plant. Rob Gray is a strategist, and Russell Barnett is a consultant. But James, who's the founder of Resource Capital Fund, saying his company is not investing in lithium because he thinks it's over. On the other hand, you have Wesfarmers making a bid for Kidman Resources because on the basis of Kidman's resources, lithium. So you have two different points of view. So it's okay in your assignment to have a great deal of uncertainty. It's almost always the case that where there's great value, there will be uncertainty. If everyone knew the right answer, then of course that would be reflected in the share price there. But back to my point about this barriers to entry. So, here's a picture of my aunt and uncle. I'm only kidding. It's not my aunt and uncle. Which would you expect the richest man in Australia, what do you think he's invested in? Have a guess. Cardboard. Richard Pratt makes cardboard. Hardly high tech. And yet, it's because he's able to supply cardboard cheaply at a rate that no one else can, and so his profit margins are good, and he's cornered the market in cardboard. So it's very hard for people and he's set up a distribution system and a supply system and relationships that are very difficult for anyone else to compete. And he makes enough profit so that it's not enough for a big company to come in, but enough to make him Australia's richest man. The other two people, so this is, does anyone know who she is? I'm just interested in the... Okay, this is Indra Nooyi, and she just stepped down as CEO of a company that makes sugar water. They put sugar in liquid, and then they sell it. And it's a Fortune 500 company. It's Pepsi. And Pepsi makes a big fortune. That's just nothing more high-tech than that. So a lot of the times, it's all in your mind, the barriers to entry, because they're able to build up a margin because people associate a particular feeling, experience with this product. Ken Shello, he's stepped down. He's a CEO from American Express, so he's an African-American, and he was a CEO for a long time. And he took American Express from and also ran to one of the dominant credit card companies. But again, a credit card company. Everyone, there's lots of credit card companies, but he's able to associate American Express with the sign of success. And probably the most, another remarkable instance of this where branding matters, where barriers to entry comes from branding, is from Korea. This is a sort of a semi-biography by Korea, by Uni Hong. And she talks about Korean cool. When she was a child in the 1980s, her father, an economist in the US, was called back to Korea to help build up the economy. And they thought, oh no, we're going back to Korea. Why? The TVs suck. In fact, there was a company there called Samsung. They called it Samsuck because the TVs kept on breaking down, etc. So they went back. And the government made it, and with the result of a whole bunch of policies, Korean products began to become competitive. But they found that people weren't buying them because they weren't cool. And she said back in the 80s, she would never have thought that Korea could be thought of as a cool country. But the government invested in it, and so decided to project this image of a cool country. And you might have heard of K-pop. That's part of a conscious branding by the company to make itself cool. So nowadays you have Korean products as being seen as cool, and you're able to command some kind of a margin. So my point being, you need to look at not just when you're looking at the economics, but think about the margins. This doesn't depend on technological factors, but it depends on brand names. So it can be difficult, though. So one reason, as I said, Warren Buffett has cottoned onto this. So he will often buy products such as Heinz and Kraft because he thinks these are high barriers. These have high barriers to entries because of their brand names. To give you an example, how many of you have brushed your teeth with a Colgate product? It's pretty expensive if you compare it to the other cheaper products, but you just buy it. I mean, I know the value of, and I think, but I just go ahead and buy a Colgate product anyway. So that's the power of branding. So, but recently, they've been under pressure because cost-conscious customers have shifted towards cheaper private label brands, while health-conscious consumers have favored more natural food products. And that's caused a massive decline in Kraft Heinz. That's, again, the kind of qualitative analysis you need to do. It's not just about working out the betas, but you need to actually undertake some kind of qualitative market analysis. On the other side, you can look at a company. So one area you might wish to specialize, and some companies specialize this, on governance. They look at the quality of management. They look at the alignment of incentives between the management and the shareholders, their level of investor protection, and they look for some kind of event where this will be affected by there'll be some kind of a change, and then they'll invest on the basis of that particular change. But what we're going to look at now is how do macroeconomic settings, growth and government policies affect equity returns. That's going to be the subject of the rest of this lecture. So how do they affect equity returns? Through changes in the discount rate. So whatever government policy you have will also be reflected in the discount rate, which is the cost of money, and that's affected by economic policy. So one example, I've shown this before, but just a reminder. So in 1971, US President Nixon was faced with a contraction in the US economy. So the US economy was declining, and they wanted to increase the money supply. But because the money supply was tied to the amount of gold, there was a promise by the US government, a theoretical promise, that if you brought in the dollars to the US government, then the US government would give you some gold. So there was a linkage between. Now that's fine, except that if the supply of gold doesn't increase in line with the economy, then the money supply shrinks, and that affects the growth in the economy. So he said, as a temporary measure, he wanted to direct his secretary, what they call the treasurer, so they call the minister the secretary, to suspend the convertibility of the dollar into gold. So in other words, the US dollar wouldn't be backed by gold anymore. You just have to accept the US dollar. So Ray Dalio's epiphany was that, so his first thought was, if they're going to de-link the government dollar from gold, it'll be chaos. People will refuse to accept the American dollar, and then the markets will fall. God knows what they'd accept, sheep entrails, I don't know. But he didn't think that one through, but he just thought people wouldn't accept the Australian dollar. The American dollar. So the next day he walked onto the floor of the New York Stock Exchange expecting the stock prices to plummet. Instead, what happened is that people thought, the money supply is going to be increased. No one really goes and asks for a dollar. No one cares about gold, but we care about the dollar, the money supply. Now that we know that the money supply will be increasing, interest rates will come up, and we can expect money to get cheaper. And so with a lower discount rate, the stock prices rose up. So he misunderstood its implications. So he says, markets, and his main insight into this is, markets move based on shifts in conditions relative to what the markets are expecting. the greater the difference between what the market's expecting and the shift, then the larger the change, the larger surprise. So when countries have too much debt and the lenders won't lend them more, they're squeezed. In this case, the US invariably print money to relieve the squeeze. The unexpected wave of new money cheapens its value, alleviates the pressure from the tight monetary conditions, sending stocks and gold higher. So you can put this into practice right now. Why forecasting interest rates is the biggest game in town. Tomorrow, the Reserve Bank of Australia will decide whether or not it's going to change its interest rate. It's got a choice between leaving it unchanged, increasing it, or decreasing it. So if you're a betting person, this is your chance, and you think you can forecast, this is your chance to decide, to make some money, or lose some money. What's different this time is it's a 50-50 bet. So the rate cut, so this is a good spot. The RBA likes to keep people guessing. So there's a 50-50 bet as the Reserve Bank of Australia gets ready to cut growth and inflation forecasts. I looked at this just before this lecture, and they said Australian dollar headed for a fall as Reserve Bank mulls interest rates cut. If they cut interest rates, the Australian dollar will fall because it won't extract as much overseas interest from people buying the Australian dollar, given its lower interest rates. But we can expect stock prices to increase, so the market will rally. The question is, should the government cut interest rates or not? And it's in quite a predicament at the moment. So you see over here, we see that on the one hand, you have Paul Brennan, so some commentators saying the reserve banks should decrease interest rates because we need to stimulate, to help revive inflation, we need to stimulate the economy to a lower exchange rate. On the other hand, the CEO of the National Australia Bank says no rate cut is needed, that the economy is strong enough. What's puzzling, why they're in a quandary, is that we're having two conflicting signals. On the one hand, so you don't have this slide, I just got this on your things, but on the one hand, we have gross domestic product. So the measures of Australian productivity are slowing down, which normally would suggest that's in favour of a rate cut to stimulate the economy. But on the other hand, we've got very strong jobs data. So in New South Wales, employment is at a 40-year high, or unemployment is at a 40-year low. So he had a puzzle to solve why expenditure was not improving when so many people were being employed. He said the bank was devoting significant resources to understanding this tension. This actually isn't just an Australian problem. So some people have said this is a productivity problem. So one way of doing this is that there's a lot of spare capacity, and while people are in jobs, they're not very productive, so that's why they're not being paid more, and therefore there's not enough consumption. But so the trick is to increase expenditure. That would be plausible, except that we have the same puzzle elsewhere. So in the US, we have the same puzzle over there. We have a booming jobs and low inflation. So the labour market in the US is experiencing right now what isn't supposed to be possible. The consensus amongst economists would have been you couldn't have a 3.6% unemployment rate without seeing the rate of job creation slowing. So, and having an inflation surge, a worker shortage should mean employers bidding up wages. But that's not what's happening. The jobless rate has receded to its lowest level in 5 decades. In fact, even hourly earnings are increasing, up 3.2%, but still there's no inflation. In fact, one of the puzzling things is that for the last 10 years, despite the big differences between, and there are big differences between President Obama and Donald Trump, is that they've actually pursued the same policies. In terms of the economy, it's been essentially the same. There's a big difference in rhetoric, obviously, but by and large, Obama pursued a huge deficit, basically Keynesian economics, financing a huge deficit, whilst at the same time interest rates were very low. And that's pretty much the same things continued under Donald Trump. He's financed a huge deficit with also, whilst at the same time wanting to keep interest rates low. So this puzzle, the booming jobs isn't the puzzle. The booming economy isn't the puzzle, because that will happen if you have a huge deficit. But the low inflation is what people can't explain. As it says, Warren Buffett says, no textbook could have predicted the strange economy. Unemployment remains low, interest rates and inflation not rising, and yet at the same time the US government continues to spend more money than it takes in. So why is this an issue for the RBA? Because the RBA now has to decide, is it going to listen to take more heed of the jobs market? If it looks at the jobs market, it says there's no need for an inflation cut. If it looks at the growth rate, though, it looks like the economy is slowing, despite there being huge employment, and so there's a case for a rate cut. So the implications for investors, if you don't want to do that boring stuff about analyzing companies, you can decide you're going to focus on the big picture. You can be a macroeconomist and forecast changes in inflation rate. So you can try to anticipate changes in interest rates and profit from those changes, or you can, another way is to choose assets in your portfolio that are trying to hedge against the unexpected changes there. In this respect, what kind of assets would you pick? Well, it turns out that larger companies tend to benefit more from, at a very low interest rate environment, larger companies benefit more from a decrease in interest rates than smaller companies. So let's look at this other question. Leaving aside this interesting issue about unexpected changes in the cost of money, what's the relationship between economic growth and equity returns? Do we expect there to be a steady, so we expect if there's a high economic growth, do we expect the share market to respond accordingly? Can we infer anything about the economy, what's going to happen to the economy if the share market indices rise and be discouraged if they fall? There. Should we be concerned about the value of equities if there's a recession? There. So to give you an indication, there's the kind of things. So we have here, The Economist is expecting a recession in 2015. So Steen Jacobson, looking very stern over here, says, Australia's headed for a recession, nothing can be done to stop it. The mining boom has spread complacency of the past decade. It's now too late to avoid a recession in 2015. It's now 2019. No recession. The odds of a recession, again, Australia has run out of luck. Odds of recession, nothing. George Megalogenis argues that Australia risks becoming globalization's next and most unnecessary victim because we've got the wrong policies. And then you have Remy Davison saying Australia must prepare for the mother of all hangovers. He's the Jean Monnet Chair in Politics and Economics at Monash Universities. He's a conflicts expert for the United Nations and a member of the Council of Optimising Government Performance. He made this prediction back in 2012. He said, in 2012, I predicted an Australian recession because of a delayed tsunami effect of the global crisis. That didn't happen. So he's saying, but now I'm actually quite confident there's going to be a recession. This was back in 2015. So the ducks are all lined up. A perfect storm approaches. Welcome to capitalism. We hope you enjoy your stay. You know, it's one thing to be wrong. It's another thing to be mean-spirited about this. So what's this thing about a perfect welcome to capitalism? We hope you enjoy your stay. I mean, why? What's wrong with capitalism? What's wrong with... and why be gleeful almost about people suffering a recession? How good is the stock market at predicting this? So we have people say that Wall Street is an early omen of movements still to come in gross national product. Commentators quote economic studies alleging that market downturns predicted 4 out of the last 5 recessions. He says that's an understatement. In fact, the stock market, if you follow the stock market, Wall Street indices predicted 9 out of the last 5 recessions. So the market seems to overreact or under. So when the market goes down, it doesn't necessarily mean that there is a recession. In fact, in 1987, when the market crashed, nothing much happened in the real economy, it just continued. So, economists aren't good at forecasting recessions, so we can accept that. That seems to be fairly widely accepted. But why aren't economic growth and share market prices closely connected? Why isn't there a close connection between economic growth and share market prices? 2 reasons. So we'll look at, one is that there's a policy response to changing economic conditions. So when there's a fall, when the market signals a fall, then the government acts in response. So at the time of the financial crisis, the government saw that there was a crunch in credit and it changed its policies to avoid the crunch, to keep the credit flowing. So it either directly stimulates or constrains its spending in the case of a boom, or in the case of recession it stimulates. And then it changes its monetary policies. So it'll decrease interest rates in response to a recession. So let's have a look at the first condition, an example of this. So in 2008, when we had the global financial crisis, the government decided, if we don't do anything, the economy will slow down, we'll go into recession, we'll have a 10.4 billion stimulus package, and we'll give that to pensioners and low-income families because they're more likely to spend it rather than to save it, and therefore that'll stimulate the economy. They also had a 1.5 billion for housing construction and 187 million for training places. And then, because the banks couldn't get money, most of the banks were financed from overseas funding, so they couldn't get money in the international markets, because when NAB went to Europe, they said, "Who are you?" I said, "Well, we're NAB or ANZ," and they said, "Where are you from?" Australia. Says, "What? Australia? Who knows what's happening in Australia? We're not going to lend to you." But so the government said, "Well, we'll step in. We'll guarantee your borrowings in return for a fee," and then the banks were able to get much cheaper lending than they would have otherwise. So that also helped spur credit to the economy. So what the bank hopes to achieve by lowering the risk-free rate of interest is to this situation where you have before monetary easing, and then by increasing the money supply, then you have a greater amount of credit at lower interest rates across all levels. So how does it do this? It does this by quantitative easing. I want to explain the mechanics of quantitative easing to show you how they flow through to the economy, and because that's part of the debate. The debate about quantitative easing is in part that it's inflationary, but also the way it works is controversial. So it's helpful to have an understanding of what happens. So the central bank creates money, so it just decides we'll make some more money, just like that. And it has 2 ways of doing it. It could give it to the government, and the government could spend it. That could be direct fiscal stimulus. But for whatever reason, that's seen as being too easy. They say, what if the government started spending everything? And who can trust the government to do the right thing? So we need to get it to the banks. We're creating the money, and now we need to get the money to the banks so that they can lend, because they're professionals. So they know who to lend to. So how to get the money to the banks? You can't just give away the money to the banks. That looks a bit odd. Yes, here's some money. You're an NAB, yeah, thank you. So what they do instead is they buy the bonds from the financial institutions. So they have government bonds or they have corporate bonds from the banks. Now you might think this is a bit odd. They're simply exchanging one kind of asset for another. So you're buying the government bonds back, and then you're giving them cash. Right? Or it could be a corporate bonds. So how does that increase credit? Well, it now means that the banks have reserves, high-quality reserves. So rather than the bonds, they now have this high-quality cash that they have, and because their reserves have gone up, their lending ability has gone up with this high-quality reserves, they're now free to lend more. And that reserves, the high-quality reserves, increases the lending capacity, so the increase in effective lending supply, credit, that pushes down interest rates. The lending to businesses, which causes people to borrow more, and so they spend more and they create jobs and they boost the economy. That's what's happening. But, so who wins? The people who win, now when this happens, interest rates go down and the lending to businesses and people borrow more, so stocks go up. The value of company stocks go up because companies can now get money at lower rates. So the people who own stocks benefit. But the people who own stocks aren't your everyday investors. It's typically the richer investors who own stocks. So asset repurchases have boosted the value of household financial wealth held outside pension funds, but these holdings are heavily skewed to the top 5% of households holding 40% of these assets. In other words, the rich have got richer under quantitative easing. The problem is as well, if people, there's a liquidity trap, which is if that people just take the lower interest rates, the cash, and they don't lend it, they just hold it because they're too scared about what's happening. That's an issue. So back in, so one of the issues with quantitative easing, as I said, is what are the effects? If it's straight out stimulus across the board, people don't mind. But what people are fearing is that certain asset classes that are already inflated, overvalued by some measures, will get a further boost as a result of the lower interest rates. So this explains this comment by Christopher Joy, who's, from the Financial Review, he doesn't lack any self-confidence, and so he says, whether or not the bank will cut its interest rates tomorrow will be an intelligence test for Philip Lowe, who's the Reserve Bank governor. And he says, we figure out whether Philip Lowe is half smart and worth the 1.02 million he pays himself. Because it would be incredibly dumb to unnecessarily cut the cash rate and influence the election result when this will get capitalized straight back into house prices. So his argument is quantitative easing will cause people simply to take the money and buy housing and lift up the house prices, which are already overvalued, rather than being a correction. So it won't stimulate the broader economy. Now, quantitative easing assumes that interest rates are high enough to be lowered. But what if interest rates are at zero? And you can see here that in the US, sure enough, interest rates are above zero. They've gone up to almost 3%. But in large parts of the European area and in Japan, interest rates are actually below zero. So quantitative easing isn't going to really help anything. So when the risk-free rate is zero, quantitative easing is ineffective. We're in a liquidity trap. So people in this case, they hoard the extra cash. And because there's no inflation, there's no cost to this. Normally in an inflationary period, there's an incentive to spend the cash rather than to keep it because you're scared you're going to lose money. But in a deflationary period, you actually gain by not spending the money. So if you're concerned about this, then you will hoard it rather than spend it on risky investments. Okay, sorry, I got caught up there with the time. We'll come back at 4 o'clock. They're very patient. No one says anything. I don't know.
It's unlimited?
I think so.
Ah, okay. Thanks.
Okay, so the point of this particular slide is that decreasing interest rates is all very fine when the companies will push out the interest rates and investors actually spend money. But if the investors simply take the money and don't invest in it, that's when the company is caught in a liquidity trap. And we can see here that you see a lot of companies and funds doubling their cash holding. In the kind of period that we're in, a liquidity trap arises for two reasons. One is that, as I said, the cost of holding money decreases. If there's no inflation, then you're not losing any money not losing any value by holding on to money. So the opportunity cost is decreased. And the second thing is that there's a lot of cash because people don't see any attractive investment opportunities. So why investors prefer to hold cash or risk-free bonds when they're paying zero or close to zero interest rates is because the opportunity cost, two reasons. Opportunity cost is close to zero. There aren't other attractive, and secondly, there aren't other attractive investments around. So they must be really terrified or concerned about the future. So the answer is people are concerned about the future. They think there's some kind of global recession or something that's happening, and so it's best to hold on to your cash. So, for instance, in Perth, people aren't buying property because they're expecting the property market to decline. And so it becomes a self-fulfilling prophecy. You're holding cash, you're not investing in property. The lack of demand then causes the property values to decrease. It becomes a self-fulfilling prophecy. So going on to this thing, so we're living in an unusual period with high risk aversion. But going back to the question, isn't economic growth associated with high equity returns? Can't we expect to see good, strong economic performance associated with higher market performance? The answer is no. Quite surprisingly, in the long run, economic growth is largely irrelevant to forecasting share prices. In other words, if you know what the economic growth is, it's not going to help you with forecasting share prices. It's quite remarkable. The key factor is the proportion of profits. What companies are interested in, what drives up the value of a company are the profits that they can make. So what I'm going to explain now is that economic growth isn't necessarily associated with high profitability. And even as underperforming economy, on the other hand, can be associated with strong share market performance if the companies in the market capture a larger part of that profit. To show this in general, one broad bit of evidence, have a look at this particular graph. This graph tells you the real returns to equity, so after adjusting for inflation, and the real gross domestic product, so economic growth, over a 102-year period, 1900 to 2002. The yellow is the economic growth. The green is equity growth, what we associate with the share market. So if you look across these companies, Belgium, Italy, Germany, France, Spain, Japan, Switzerland, Ireland, Denmark, Netherlands, UK, Canada, US, South Africa, Sweden, Australia, you see that the highest performer over that 100-year period, the strongest performer is Japan in terms of economic growth. But Japan is below average or below the median in the stock market. In fact, the winner of the stock market, so the best returns over this period, has been the Australian stock market. Surprising. Whereas the Australian GDP has been okay, but nothing, it's pretty much in line with the middle of the pack. The next company, the next one down, is that socialist haven, Sweden. Sweden. You associate Sweden with high taxes, generous standard of living, great social security, but you don't think of it as a booming stock market. And then I bet you if I asked most of you or many people around which would be the third country that had the best, hardly anyone would guess South Africa. In fact, if you look at it, of all the countries listed over here, South Africa has the lowest GDP growth, but it's had the third best performing stock market. So how do we explain this? Well, the profits depend on as I said, the value of a company depends on the profits it generates. And let me explain this by another analogy that I'll make. And this is a true story. It relates to James McClemens, the person who came and spoke on last Tuesday. Back in the 1980s, when he was in his late teens, James invested in a video store in Port Hedland. Mount Newman. He lived in Mount Newman, which is up north, close to Port Hedland. So that's a few thousand kilometres up north. And back then, up north, you had the ABC, and that's it. There's the ABC or a video if you wanted to come home at night after a hard day at the mine. So what do you think people chose? Most people chose to watch. Rather than Four Corners, they wanted to watch a video. So the video stores boomed, and James was one of the early investors, made a fortune. 2 years later, he sold out. He saw what was coming next. The demand for videos boomed, but the video stores began to go bankrupt. Why? Because of intense competition. There's lots of videos being rented out, but there were so many new entrants coming in that they were competing for limited market share, so they found it very difficult to profit. So you can see that the consumer benefited from cheaper videos than they would. The companies supplying the videos didn't make that much profit. So what's happened in Australia is that while the economic growth over that 100 period has been okay, respectable, the benefits of that have been captured by a small coterie of investors. They haven't issued new capital. It's not new money coming in. The existing shareholders have benefited. Similarly, from Sweden, share ownership in Sweden is highly concentrated. In fact, one company, the Wallenberg family, own about 20%, 25% of the Swedish stock market. So while, again, their growth has been respectable, the profitability of the companies has been able to be retained by a few, and similarly with South Africa. So another example of this, in a different context, you take this to China, and this is it's almost 15, 16 years old, but the numbers are kind of familiar. You see that China's got a stock market. In 2006, it had a return of 18.5%. So back then, people were saying, 18.5%. Is this the start of a bull market in China equities or another false dawn? Because it turns out that the Chinese stock market, while the economy had been growing massively, the stock market hadn't been doing so well. They said, with China expected to put in another year of 9% plus growth and the global economy expected, it seems a no-brainer to buy China. They said, right? In fact, it's not so obvious. Why? Because whilst the economy is growing, there is brutal competition there are new suppliers coming in, new competition, so the profits for each company is decreasing. Consumers and everyone are benefiting, but the companies are not from the competition. So this, if you're So this theory, I've just explained this a bit more in the readings. Does the share market really matter? In terms of the larger economy, what the share market does or doesn't do really does make no difference to the broader economy. You've had periods in the US when the stock market has been booming and the economy has been going down, and vice versa. Why isn't there a direct link? So economic growth is a function of productivity of capital, equipment, equipment and labor. You have more machines, more workers equals high economic growth. More efficient workers, high economic growth. Better educated, better trained workers, higher efficiency. Okay, so these are the three factors. But who benefits from the high productivity? You can have three potential parties: the providers of capital, labor via high wages, and consumers via lower prices and high quality goods. How those gains are distributed across capital, labor, and consumers is a function of supply and demand, and also political influence. So you see here that costs in the US, customers have benefited from cheaper televisions, toys, and phones, similar with us, cars, but things like education, childcare, and healthcare have gone up in value. It's a function similar to this example, 200,000 a mine worker. So in Australia, we've had the 8-hour day as early as 1856. So this was pioneered in Australia. But the only reason why this was able to be pioneered in Australia is because there's a shortage of workers, kept up as well by the White Australia policy. So immigration was restricted, and so that kept up a shortage of the worker supply, and which allowed the wages to be higher. You have this in Germany. One of the issues that Europe has is that Germany is hyper-competitive. It's super competitive relative to the rest of Europe. And so that's causing the euro to be higher in value because the German exports are keeping the euro high in value, which means that countries like Greece, etc., which are less competitive, are suffering. They aren't able to get into a competitive position. But part of the reasons why Germany was able to get themselves into this position is that from 2000 to 2010, productivity increased, but the after-tax income for people for workers in Germany increased by 1.4%, not per year, but total. So Germany took steps to ensure that rising productivity translated into more people in the labour force rather than high wages. So this is what I mean by a political element to it. There's a kind of a trade-off between you increase productivity, if you take the increased wages, then there'll be more unemployment, or you can choose not to take it and you can have more people in the workforce. And so this is part of the reason when people talk about inequality. It's what's happening in the world now is that the supply of labour, the proportion of the economic wealth going to labour has decreased, and the proportion of wealth going to capital has increased. You hear a lot of talk about Donald Trump's wall and the fact that he's building a wall around the US. The reality is that Australia has a much, much more restrictive immigration policy than the US. The US is a far, far more open economy than Australia, in practice. So regardless of this rhetoric, if people came to see what happens in Australia rather than in the US, there'd be possibly a lot more criticism, but there's nothing. What he's doing is quite mild compared to what is being the active policy in Australia. And what that means is that because there's more lower skilled labour coming into the US, they have very, very low minimum wages, where in Australia our minimum wage is quite high. So economic growth, but what about individual companies? Economic growth isn't correlated with stock market returns, but what about individual companies? doesn't an increase in economic growth help increase the company value in the short run? So the answer is it depends. What happens to a company is whether or not its economic growth affects the company via two ways: an increase in cash flows or an increase in growth options. When there's a high economic growth, then investors value companies make investment that can capture the profits from the growth. So one reason why General Motors is valued less than Tesla, even though it's making more cash and more profits, is that people think the future isn't with General Motors, the future is with Tesla. So it's the growth options that they think that Tesla is better able to capture that's coming. So this is the way, this explains this kind of a puzzle. It looks like it's irrational. A company that's making profits is valued less than a company that isn't making any profits, but it's because of the growth options over here. So there's this tension here. Oh, there used to be more of a tension, and this tension has largely disappeared, but oftentimes the managements will say, we've got all this cash, we don't want to give it back to you because we think we can invest it in growth options. But then the companies, the investors say, no, we think you should give it back to us because we don't think that what you're investing in is worthwhile. So investors may think managers are being excessively optimistic and moving outside their area of competence. So this is an example. I put this up in a couple of years back. But it turns out to be been quite prescient. In this case, the investors turned out to be right. They said, Richard Goyder has just spent $700 million to buy Britain's home base, said he was recently approached by an investor with a warning, saying, we will buy some shares for you, but not if you go overseas. I laughed at him. At the time, we're thinking about the UK thing. As a CEO, there's nothing like growth. It's what everyone wants, but they want risk-free growth. That's the trouble. And so this is the challenge that as a CEO, and that's what you as one day as a CEO will face, is convincing investors that you are taking their money and investing it in some profitable project. He turned out to be wrong in this case, but they're showing again by investing this Linus that they're not scared that they will take that risk again. So it's part of the job of a CEO then is convincing the company or the investors that they are keeping, that they have growth options and that they're well placed to exploit them. Okay, so more of this is the summary so far is that the share prices react to unexpected changes in economic growth. In the long run, economic growth is largely irrelevant to forecasting share prices. That's a counterintuitive finding. The key factor then is the proportion in forecasting is the proportion from economic growth that's captured by existing shareholders, as opposed to new entrants to the labor market, labor or consumers. Which means that if a company is issuing new shares, it won't necessarily be a good sign for the company. In fact, the issuing of new shares by a company is often followed by a decline in the share price, because people think if the company was really confident, it would be able to fund it from its existing shareholders. If they're issuing new shares, why would you share the wealth with the new shareholders? So one postscript analysis of the economy. So we often find that. So there's a sense the world is going to rack and ruin. That this is a bad time in the world, but this is largely a developed country's perspective. From a global perspective, we see that income inequality is decreasing around the world. So if someone came from Mars and had a look over here, in fact, this would be the most peaceful, better time in terms of everyone than in the world. There's a good argument that this time is the best time ever for the Earth. So if you're interested in this kind of analysis, and this is the kind of thing that I'm interested in, is you might look at these books. The British Industrial Revolution, I'll talk a bit about this in a moment. The Next Convergence. So the title of this book refers to an earlier book which talked about the Great Divergence. The Great Divergence was a story about how the West outpaced the rest. There was a period about 500 years back where the Western world experienced a dramatic increase in standard of living and left the rest of the world behind. Michael Spence, the Nobel Prize winner here, is talking about the next convergence when standard of livings are coming closer together. So he talks about the future of economic growth in a multi-speed world. Ha-Joon Chan is an economist, a Korean economist based in Cambridge, and he provides a very good view. He talks about how you can't explain the world using this one neoclassical model, so he prefers a heterodox economics approach. I'll put an article up by him in the recommended readings. He talks about 23 things that economists can't explain, and I found that insightful. One question is how did Britain become great? And when you think about it, it's a small country over there. Why did it take advantage of these technological revolutions? So what's obvious, and what no one disagrees, is that Britain's industrial revolution, the increase in productivity, was characterized by a series of technological breakthroughs. So one particular explanation for this is that the British people were smarter than anyone else. So they invented that stuff, and therefore that stuff led through the Industrial Revolution. But Robert Allen comes up with a different idea. He makes the point that actually this kind of insights, that technological breakthroughs, occurred in many other places at the time, but they weren't widely adopted. So the question is, why did the British adopt this earlier than anyone else, and as a result increase their productivity? And the surprising answer is, or not the surprising answer, but the answer is high labor costs. If you have very cheap labor costs, there's no incentive to innovate. But if there are very high labor costs and there's a labor shortage, then any increase in productivity from mechanization makes a big difference. And so you're forced to invent. So you have a greater incentive to adopt these innovations than other countries. So he looks at labor costs in London and compares them with France, China, and other places, and finds that the high labor costs in the UK provided a bigger incentives for people to innovate than they did in other countries. So that was the idea that's what led to the spur in the widespread adoption of the technological breakthroughs. And you can see that comparing this hourly compensation costs in manufacturing, US dollars as a percentage of costs in the US. So in the United States, it costs $23. In Australia, it's 82%. So if you use the United States as a standard, in Australia, it's 103. So we're less competitive relative to the US, but there are other countries that are cheaper. Norway has much higher labor costs, and so you'd expect Norway to be some more pressure towards automation compared to the US. Similarly for Germany. Okay. Finally, the last thing, which I won't spend some time on because I didn't spend some time in the afternoon, I simply want to alert you to Porter's 5 Forces framework. I'm not going to cover this in detail, but you can Google it. And in fact, there's a question in your tute. So I like to apply this to the airline industry. Many of you will have come across this in your other subjects, but if you haven't, this is a good opportunity for you to do this. It's a really useful framework to work out the profitability of a particular company. So that's Michael Porter's 5 Forces framework. Okay, I stopped here. We seem to have... I seem to be more efficient in the afternoon class compared to the morning class. The tutorial comes on at 5. Quiz questions. You can get a head start here on this. Okay, the afternoon quiz is, who's the central figure today in the talk? Come on. Manga. Yeah, good. Except that Dan, so I outsourced this to Dan, Carl, and he picked Charlie as the password. So the password is Charlie.